the daily edition of Market Wrap with Mo Ansari.
Brought to you by Compac Asset Management,
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compac Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. Now, let's go to Mr. Keith Hennessy. He's a research fellow at the Hoover Institution and a lecturer at Stanford Business School. Mr. Hennessy is also the former director of the National Economic Council for President George W. Bush, a position now held by Larry Summers in the Obama White House. Mr. Hennessy, welcome to Market Wrap.
Thank you for having me on.
Let's talk a little bit about the unemployment numbers. I know everybody's looking at the markets and what's going on in Europe, and maybe you can touch on that a little bit later on. But let's start with the 290,000 jobs that were added in April. That's the fastest pace in 4 years. But the jobless rate rose to 9.9%. What is your take on the latest employment report?
I think it's good news. I think it's not great news. But frankly, after the period of time we've been in over the past year and a half, I think it's nice to have some good news. So creating 290,000 jobs is a good thing. As I understand it, the unemployment rate ticked up from 9.7 to 9.9, but that's in part because more people entered the workforce and were looking for work. I think the economists look at the labor force, the employment to labor force rate, and that's been going up fairly steadily over the past few months. So that's a good thing.
Let's talk a little bit about that. Let's talk a little bit. How do you think we are going to look for the second half of this year? There are some expectations that the economy is going to slow, and this job creation that we are seeing now will also slow, or it will be a long time before we get back to the levels we were a few years ago. Would you agree with that assessment, or do you think the economy will continue to grow like it has in the last quarter of last year and the first quarter of this year?
Yeah, I don't know. I can tell you how I think about it. Which is that for several months now, what I and smart people I trust have been focusing on is labor force, is employment growth. We've been saying for a while that jobs is the key, and it's been the missing ingredient so far. Now we've had a few months of steady and accelerating job growth, and so that's a real good sign. If that trend continues, and especially if it accelerates, then that provides room for optimism. At the same time, we've obviously seen that our economy is not quite as robust as we'd like it to be. We've seen how the markets can easily get jittered, whether it's a trading glitch or problems overseas in Europe. So we're clearly not out of the woods yet, and you want the economy to be flexible. You want it to be robust and growing. The stimulus is starting to taper off. The census bump in employment we know is temporary. So we just don't know, will this job growth continue, and will it become self-sustaining and accelerating? If so, then there's room for optimism, but as I was saying before, we need faster growth just because we're so far behind the full employment level that we'd all like to be.
Mr. Hennessy, is the current administration doing enough to assist with job creation? If not, what do you think can be done to help people get back to work?
Yeah, I think that administrations always get too much blame for the short-term macroeconomy when things are going poorly, and take too much credit when things are going well. I would rank the factors in order of importance. I'd say the business cycle is number one, which isn't under anybody's control. In terms of policy tools, I'd put the Fed and their ability to control the money supply with the Fed funds rate, at least in the short run, as the second biggest factor. Now, obviously, the Fed funds rate is turned down basically to zero.
Right.
So then you get into the third biggest set of impacts, which are all the policy changes. But you're talking about a gap of millions, and policy is sort of, the dials are turned kind of where they can go, unless you're willing to tolerate a budget deficit that's, well over the 9% of GDP level that we're looking at right now.
Mr. Hennessy, let's talk a little bit about budget deficits. One that has a huge deficit right now is Greece. They've got some serious problems right now. In Europe, we were expecting that the ECB would come in and say, okay, we're going to start buying up some of the debt, or quantitative easing is what the market was looking for. The ECB has so far not done so. Where do you think we're headed with the situation in Europe? Do you think we have more problems to come with Spain and Portugal and all the other countries? Or do you think they will be able to curtail this situation in the short term?
Yeah, I hope they will be able to curtail it. I'm not enough of an expert in the finances of some of those, troubled fiscal situations to be able to give you better information than you can get from others on it. I do know that Greece's problems are largely of Greece's making, and that's in part because elected officials there were over-promising. Mm-hmm. They were making promises without the capacity to actually fund them. And that, we see that here in America. I've heard a lot of people say California is Greece, as California continues to wrestle with their budget problems. People are making the comparisons with Spain and Portugal. Mm-hmm. And I think that American policymakers are wrestling with it, maybe not quite as immediate, but at least as severe in the long run.
One of the problems I have, and I'm looking at this from a simple point of view, I've asked this question to quite a few people. The solution that we've seen over the last few years is whenever we see large institutions like banks, we saw that on Wall Street, they got into trouble, so we gave them a whole bunch of money. We are looking at Greece that has indebted, they can't pay their debt, so what the ECB and the EU are doing right now, and the IMF is doing, is saying, okay, they're in debt, so let's give them a whole bunch more money and put them further in debt. Do you think this is just delaying the problem? Because if somebody can't pay their debts right now, if you put them more in debt, how can they pay that more debt back in the future?
Yeah, I'm not sure that the solutions between the banks, the comparison between the banks and something like Greece are directly comparable. But I do know that obviously no one wants to have to do these situations. The policymakers who bailed out the banks, I was part of the Bush administration when we did the TARP. Mm-hmm. Nobody wanted to do that. And so, when you have only one bad viable alternative in front of you, you have no real option but to take it. Now, what that suggests is you also need to be able to think when things have calmed down and when you've gotten past the crisis is how do you harden the system.
So right now there's a Hobson's choice in Europe that they can't do much except give Greece the money, because if they don't, Greece goes bankrupt, and so it creates a problem with Portugal and the contagion and so on goes the situation. So that's really the option that they really don't have an option right now. But then let's go back to financial reform here. We have not really taken care of the problem now, have we, where the banks are still there. We're not breaking up the banks. They're still too big to fail. They're not going to put the money in that if they do start to fail, to put $50 or $100 billion that they put into a pool that would be used to liquidate them. That's not happening. So if they get into trouble again, it will be the U.S. taxpayer again that'll have to go in, bail out, or put a whole bunch of money in before they can even be liquidated. So how are we fixing this?
I think you're in part true. I think that the legislation that's being worked on now, it tries to address at least one of the biggest issues, which is that there wasn't a parallel to bankruptcy for these large financial institutions. Right, these large banks have certain things that make the normal bankruptcy process not necessarily work. And so, what a lot of us have been talking about on both sides of the aisle is you need federal officials to be able to have what's called wind down authority or resolution authority, like the FDIC can wind down a failed commercial bank. I was talking to some policymakers yesterday, and we were talking about whether or not it's responsible for people to say that they're going to eliminate the possibility of this ever happening again. And I think that's probably going too far, because you'd have to make our financial system so much less efficient that it would kill long-term growth. What we want to do is we want to make sure that the kinds of crises that occur are only happening very, very, very rarely. Because you've got to pick that balance point. You don't want you don't want to kill the financial engine of our economy, which allows things to grow.
Mr. Hennessy, I want to thank you for taking the time out of your busy schedule and being with us today and sharing your thoughts with us on the economy and where we are and on Europe. Thank you again for being with us today.
Thank you, Mo. I appreciate it.
That's Mr. Keith Hennessy. He's a research fellow at the Hoover Institution and lecturer at Stanford Business School.